Good morning. How you guys doing? Right. Hey everyone. Question first or educating us first? I don't have any education things outside of questions right now. Just Newman? Fuck you, Walken. Just 2 minute intro. What's wrong? Is everything alright? I didn't want to sit here through the whole thing. You ready to be rich? I hope so. We'll find out. Futures open tonight, right? Hopefully we see HSI tank some more. Given that SLD is coming to a close Tuesday and OPEX is starting, is it possible for the market to recover or likely continue the downtrend? OPEXs don't have to go up. They can also go the other way. Especially if the market's net negative gamma going into OPEX, which it is, by... Hold on. Oh, nope. Destroyed everything. $90 billion? That doesn't seem like a lot. SPX chart is so hot. I know. You appear to be floating absent a torso. That can't be real. Nope, it is. There we go. Let's pretend like I have a torso for now. Ouchies. Yo, what's cooking? Is Spy gonna get grilled or what? It looks like shit. So I hope so. It broke down Friday. Well, Thursday into Friday through its like longer term ascending trend that has been kind of persistent since we first bounced back here in like early Jan. So it's finally broken down from that. Even if we just fall to the like lower trend here, um, we're looking at like mid mid 3900s. There is probably some support here on the long-term trend that goes back to like November of 21. But that's roughly in the same area, right? Just on the technical side, on the options chain side, it looks like we're headed for a significant amount of downward momentum over the next probably month or so. Any insight on lackluster SLD last week? Also, win free pigeon whale. Never. Especially not for you because of the friendometer being so shilly. Um, I would say that we, probably saw most of what we were going to see for a sell off last week for SLD, which puts us right around. I mean, even the drop from Thursday, it puts us right around 200 BPS. If we open lower Monday, we might see the rest of the, like 300 BPS range filled in. Is SPX 3900 March 10th really going to print big this time? I have no idea. I hope so. I have some. About like 5 of them. Gurkalicious, did you cash out 300 racks on shorter dated plays like 0 DTE, 0 to 5 DTE SPX? Or did this encompass everything, including unrealized gains? Either way, our turn to tell you congrats. Thanks, Mr. Madman. More than 300 racks, and then a chunk of that is already realized. It's been good so far. Gurkha's whole OPEX is saved. Yeah, well, we'll talk about OPEX and the potential for it. Probably when I get Dork and JFresh on. I'm gonna go over some questions and stuff first, and then we'll get down to like Upstart GME, SPX towards a little later. This is the first time in a while I've been able to watch the member stream. Cool intro. I already told my mother I can't come over for chicken tenders tonight, so I'm free. Exciting. That's awesome, Farmville player. Looking delicious as always. I hope your weekend was tolerable. It was pretty decent, man. Are you planning pulling back CCs on Tuesday? Or wait and see if the volume liquidity comes in that indicates an OPEX run. As far as the 19, what are they? Are they 19 now? I know I rolled them, but I can't remember what strike I rolled them to. I have 50 open covered calls currently. They are on my highest cost basis shares at $16, and they are sold for March 17th at $17. I am not pulling those back. If they get assigned, I don't care. If they don't, awesome, I guess. All my other covered calls expired yesterday, or I closed, or not yesterday, Friday, or I closed them on Thursday. I will be looking to sell covered calls next week if we don't see that price action. Are you planning to pull back? Okay, I was looking at starting a long positions on ARCQ on the next bottom in the market, as it gives exposure to Tesla, Goog, and other AI companies. Thoughts? Um, Not bad. I think it's heavily created from, so there's always going to be a drain on your value, and you're probably, as far as returns are concerned, you're probably better off picking one of those targets. Also, AI is worthless. It's right now, like, its effect on the market is kind of a meme. It's not going to last. Um, none of those products are developed enough to hold any current value. I was looking at starting long position. Congrats on the gains. Thanks, man. Off topic. Do you think BTC will jump off a cliff at some point? It always does. Do you think a bounce will happen due to the VIX negative gamma exposure and market delta exposure? No, I don't think a bounce is going to happen. I don't think gamma exposure on VIX is negative. Gamma exposure on VIX is like pretty positive right now, right? Like the nave exposure is positive. Market's negative. Backwards? What would your expected downside targets through the end of March? Is it possible to get a recovery and more downside? Or the bear market be coming to a closer? I mean, there's no reason to think that the bear market's going to end anytime this year or probably next. Saba made some progress last week. Thoughts on another run, or did shorts close, and that's it for now? It's not being shorted as heavily as it was. I mean, like the delta skew on puts isn't nearly as attractive as it was like before Jan. I'm probably not very interested in Sava right now. One question: are my NDX March 31 10,000 puts gonna print? Maybe, but who are you gonna sell them to? How confident are you on Tesla downs by March? Would it be better to buy April theta for the upcoming drop? If you're not comfortable, then yeah, it'd probably be better to get more theta. You gotta manage your own risk. You gotta make sure that you're in a position that you're comfortable with. I have March 17 puts on Tesla, but they're not very far out of the money. They're only like $20 downside. I think Tesla's more than capable of filling that range. But if I'm wrong, I can also roll them. So, are you adding additional SPX puts this week for March 31st or some with more theta? I think I have all the short exposure that I want for now. I have Tesla 140p, Jan 24, Nvidia 160p, Jan 24. I bought far out of the money because I cannot afford the capital of at the money. Is this a bad approach to playing long-term downside? If so, why? um, I mean, you bought a lot of theta, which helps. Normally I would say yes, positioning that far out of the money is a bad idea because your decay is going to hurt more in the short term. The longer those options stay out of the money, the faster rate at which they're going to decay. So you've kind of targeted like the end price point. But you did get more theta, so you're kind of protected against that. It's not exactly where I would have positioned, but it's not awful. It's not as bad as buying like far out of the money in like a mid or short term option. Are you interested in entering FSLR? At this point, I might wait until after earnings. Will you be updating us on FSLR post earnings? I mean, if there's a significant change in their earnings, I expect that their earnings will only show more of the same issue, which is that their margins are contracting and they're not able to expand fast enough to meet demand. Do you set stops once a position goes a certain percent in the green and risk the contract being closed before the thesis plays out? Or do you wait on the thesis to play out? It depends on a lot of factors like volatility, how much theta I have. But generally speaking, yeah. Yeah, if I'm up, and there's any question of it turning around, I'll put a stop in place. You can always re-enter if you think the thesis is going to persist, right? I had a few CC GME get assigned Friday at 19. Is there any concern as far as a wash sale goes when buying shares you plan to hold long term? I'm considering selling Upstart CSPs for 30 days. No. There's no if your holding period, your intended holding period is greater than a year from now. I don't think there's any issue with a wash sale. But if you end up buying shares using CSPs, yeah, that's assignment, not purchase. I don't believe you get a wash sale for being assigned on CSPs. When you say the bear market can stay all year, do you think we continue to see lower lows? Can you explain how a bear market works? Well, in a bear market, economic conditions mean that valuations are dropping, and then the market goes down. So that's how they work. The value in the market is declining. Um, yes, we can see lower lows. I think much of the S&P is still drastically overpriced. We can see that happen all at once. We can get a crash, right? And that low valuation is realized very fast. Or we can just drag down over a year, 2 years, three, five. Have you looked at SPX plays after March, or will you reassess once the downside is realized? I'll reassess. I don't think March is the bottom of the market, unless we get a crash. But that's again statistically unlikely. Why is SPY and SPX skewing in price compared to each other? And what does that mean? Well, they are not the same. SPY and SPX have, I mean, SPY is used as a liquidity source for the S&P 500 primarily, right? Creation redemption. It's an ETF. SPX are, just the index options. So they do, SPX just tracks the price of the index. So all 500 stocks in the S&P 500, one share of SPX. SPY is a weighted ownership of all the 500 stocks in the S&P 500. And then, it's an ETF, so it has to maintain its net asset value. So they're not the same instrument at all. They track the same thing, roughly, but. Any thoughts on upcoming Rev hearing on Tuesday and Wednesday? I hope they get bought out and I don't lose all my shares. Can you explain the thought process on buying in the money leap options versus buying shares to sell covered calls against? Why do one over the other? One is significantly cheaper. Danimal. If you're buying a in the money leap, we could use GME as an example here, I guess. Say you want GME, like you're willing to buy GME at 15, right? You can buy a $15 in the money, say June 25. Yeah. $15 in the money, like Jan 25. Ideally this would be deeper in the money. But this is okay for this long. For a premium of $9.35, right? And this is per share. And then, you can sell for the next 2 years, you can sell PMCCs against this position. And, over time, reduce the initial premium cost to zero, right? And then add capital in order to exercise, which is a lot cheaper than buying 1,500 shares or buying 100 shares at 15. Also, you can't buy shares at 15. So there's two advantages there. You also actually have less downside risk with the option than you do with the shares because it has so much theta and it's so deep in the money. It's not going to be as exposed to short-term price action. Can you sum up your market bear thesis in 1 to 2 sentences? I listen almost every day, read the daily, read Pickle's picks. But it'd be good to reiterate why big downs from a macro perspective. Inflation is persistently coming in hotter than expected. Futures are pricing in a pivot from the Fed right now, and a pullback in rates before the end of the year. So the December futures are pricing in a pullback in rates. Meanwhile, SOFR and SOFRA and inflation swap speculators are pricing in 6% for the Fed's target rate by the end of the year. And since inflation's coming in hot, it's looking more and more like the Fed is going to need to increase their target rate before the end of the year rather than pivot, which means that the price of the spot price of December futures is too high, and the correction in that will likely lead to a large downturn in the market. Additionally, earnings are already starting to pull back, even though they're beating the already very low analyst expectations. Their forward guidance has not been super positive, and it's only going to get worse as the effects from the rate hikes we've already seen are felt more and more on the margins of the larger companies. The rent's too damn high. What are your thoughts on May 19 105 on CF? 105 call on CF. The dip on Friday is looking juicy, and earnings didn't seem bad from my beginner analysis. Okay, well, I'm not going to go into their earnings because I don't know shit about them. Um, but their earnings are bad. I mean, they missed on EPS. They missed 200 million on revenue. I don't know enough about their financials to say it's really bad, but analyst expectations were already pretty low. Um, their profit margins are up in quarter four, but let me see something. Decent cash flow. I did expect that in industrials. From a technical perspective, it's very much at resistance. I think these earnings were better than the reaction to what is that, quarter one. So although the revenues are down, I would probably look in like the $77 range. I definitely wouldn't target 105. 105 on bad earnings is very excessive, even if you have theta. Yeah. What happens if consumers start mass defaulting on current exacerbated outstanding credit? Shit's fucked. Yeah. Well, I mean, they could take all the like defaulted credit and pack it up into like CDSs and uh or CDOs and sell those to somebody as like toxic assets, but it would still have a pretty big impact. Defaults are never good, right? And $1 trillion of credit card debt in America is a lot. People take on more credit. Well, it depends on their rates too. A lot of people took on, personal loans at extremely low interest rates in order to pay like short-term costs as they were looking for jobs at the end of like the pandemic and stuff, right? Like the personal loan market skyrocketed through that period. I think that probably is factored into credit card debt. Um, so that might be some of it, and a lot of that's priced at very, very low and sometimes not variable rates. Just because credit's high doesn't mean defaults are equally high. I think we see more upward ladder silliness on SPX again this week. I don't know. Me and Geofresh will kind of go over that a little bit later. I don't think so. The big 4100 position that was kind of propping things up expired on Friday. Um, there's not a lot of call interest left moving forward. And I expect with SLD settling, we're going to see even more leverage placed on the downside. Will all brokers let you use in the money call as collateral? You can use an out of the money call as collateral. Can you discuss wheeling versus PMCCs on Upstart? Well, PMCCs require that you own the underlying. Wheeling only requires you own the underlying if you fuck up on selling covered calls. Well, exposed to the underlying, I should say. On CSPs, you're not exposed. PMCCs, you are. You're less exposed than you would be with shares. Profitability wise, I mean, the yields are probably better on CSPs as Upstart moves into a period of shorting. I expect that the skew on Delta for puts will go up, and CSPs will be far more profitable than selling covered calls, especially if volatility keeps dropping. I was curious why you'd want share. I mean, even in the money leaps have to be exercised. So your premium plus your cost to exercise is going to bring you roughly to the spot price of the underlying stock, except you have a time constraint, so less upfront capital, but you still have to exercise it down the road, right? You don't have to exercise it if the price drops below 15 and stays there, though. Whereas with shares, you're still holding them. Can you talk about your process for determining the SPX targets you came up with for Feb and March? It's something I'd like to be able to do on my own at some point. Uh, mm, Sort of and no. I mean, a lot of it's historic resistance and support, and then weighted towards where options positioning is. Uh, Beyond that, probably not too much info that I'm gonna give you there. You can figure it out with that information, though. Sorry, I missed that. Based on the current positioning on SPX, do you think we will ever go up to like 4150 or higher? If looking at the chart, there's a bull flag forming on the top. Do you think that might break out to 4250, or you don't really trust that TA analysis? Well, bull flags don't occur on like extended time frames. Bull flags are a high volumetric move that breaks down into a brief period of consolidation before breaking up again. Uh, what you see on SPX is on any lengthy chart is not a bull flag. Bull flags are like an intraday trading signal. So no, I don't trust that TA analysis. There is some longer dated uh positive gamma positioning at like the 4150 range. I think most of it's just sold calls. So no, I don't think we're going to 4250. Redport, welcome to Dillionaire. I don't know if I said thank you. Hit me up on the Discord after the stream. I'll get you added to the country club, man.
Happy birthday, Gert. Yeah. Yeah, we might have a chance, but we ain't got rope. Give us more than a chance, cause we ain't no
Private debts owned and scrutinized. Securitized, yeah. Hey Greg, I have 400 spies for March, but enough money to roll to June's if needed. In this situation, do you wait 2 weeks to see if they need to be rolled, or roll them if the market rises? I mean, if it's advantageous to roll them, you can. But yeah, I would probably wait and then roll if I need to. or at least take it to like the 30 DTE window. I don't know where in March you have them. Do you have them like March 31st or like March 17? I mean, one of the updates I get during the day is like 0 DTE volume. The other is the gamma weighted uh open interest for each strike, which gives you some information about the buy and sell of options. Not a lot. Volatility can help with that though. Just curious and want to learn. Was crowd looking primed for a bounce off the historic SR 9979? In addition to having good revenue and subscriber margin, how much technical versus fundamentals? CrowdStrike was a little bit of both, if I remember correctly. Hold on, I can pull up the chart. But yeah, so it was a little bit of both. It was a bounce here off the SR at 92.14. And then there was a small range for the price action to kind of well a small range in which very little volume had occurred, like this lower range here, kind of like a volatility range. It did ultimately fall down into that range, but breaking back to the upside of the trend was like a really good sign. And I mean, I sold at my mid price point, a little above, but it never picked up enough volume to hit the actual price target. But it was a little bit fundamental based, off of their earnings not being so bad. I figured that the sell off wouldn't persist, and then also there was a fairly significant amount of available support, not only on the trend but long term holders in at 92. So Baba earnings are soon. Would you be taking profits before then if PT isn't reached? Probably, yeah. Is JFresh going to explain his level 2 derivative excitement? Probably briefly. I know he's sick. How many days of theta do you generally pick up to play SPX overnight straddles? 3 to 5. Sometimes more if it's like a really important range, like the JPM color, for example, or 4100, and I'm able to enter a straddle in that range. Usually I will buy it further out, like 14 DTE, because I can hold that straddle through quite a lot of market volatility and probably profit off both sides of it, and I want enough theta to do so. So I had like longer dated put straddles open at like 4065 and 4100 for a little bit of time, most of this week, and then I wasn't closing them out until Friday. But I got to close the call side out up, and I got to close the put side out down because I bought so much theta initially around those. It's really good to have more theta around key resistances like that. You don't need to, but it can be very profitable long term. Hey Greg, I'm looking to reduce exposure to SI. I have 10 2025 leaps that are a few dollars in the money and 1,000 shares that I'm up pretty good on. Best way to have exposure. Um, hmm. So 10 leaps and 1,000 shares. Um, you'll probably have exposure. Hmm. Can't you just sell like in the money cover calls against everything and reduce your total capital exposure. Like in the money PMCCs and in the money uh, covered calls, and then you could just like reduce total capital exposure as opposed to reducing leverage exposure. I don't know. I don't know how much cash you have on hand. Like if you need the cash, then I guess that makes sense. But you'd get credit from reducing leverage or capital exposure that way. Just got in the stream. Do you currently have any SPX calls or full bear with all puts? I have a straddle that I opened at close on Friday, and that's the only call position I have for SPX. I don't really. I mean, I could play the upside in the short term. I've been playing the upside in the short term for like a month now, though. Like I didn't have any interest in playing far dated calls for most of this period of time. I don't think the pricing at like 4,000 or 4,100 is sustainable. And frankly, I think the market should be worth like 35 or 36. And that would be kind of overweight. Could you show us your overlay with the 2020 crash and current SPX chart and give us your thoughts about the current situation? Um yeah, well, I can sort of do that. Um sure, hold on. I don't know if we're going to crash. Like this price action is not necessarily indicative of a crash, right? It's just indicative of you know, people repositioning. Large repositioning, right? You know, obviously there's a lot of similarities between our price action over the last couple days and the price action that we saw leading into the 2020 market crash. And that's because, you know, informed investors are aware of their own sell-offs, right? And pulling back their long positions is, you know, just something they do. It's more like that, roughly. It's hard to line them up exactly, but they're very very similar. I only know this, and I'm only really paying attention to it because I was trading the 2020 crash, and the things that were going on then are very similar to the things that are going on now. But that doesn't infer that we're going to crash. It could just be a large correction. You know, there might be like a big sector shift that puts a lot of downside pressure on the market for a brief period of time. Not all of those have to end up in a crash. Fear in the market right now is not nearly as high as it was then. There's still people that are quite bullish. Quite a lot of them, especially over the last month. Cat update. Are you still holding March 250C or thinking of rolling? I am. I might roll them. I might just close them. I averaged them down a little bit on the drop. They're up now, or they were up going into close Friday. I got kind of distracted going into close Friday, but I think they were up. Um, maybe they weren't at the end of the day. They were up earlier in the day. Yeah. I mean, Cat's probably still fairly stable. If Dow starts selling off, then yeah, I'll close them. But I sold PMCCs against them. They're mostly free. I sold 250s against them when they were for March 17 when it was trading at like 250 the last time, and then when it fell to 43, I closed those out. So my cost basis on my open calls is near zero. I don't think I'd reposition if I saw a big pullback. I'd probably just close them, take the rest of the profits off the table, and then reopen once like a floor was found. I signed on some upstart CC last week above cost basis. I'm fine with it, but plan on using the cash to re-enter with CSP. I'm targeting 15p next few weeks. I think I've got a decent chance of assignment. Yeah, you could probably sell a little theta on those if you wanted to. I know IV's starting to crush, so you can take advantage of a continuation in IV crush, and don't sell too far out because you don't want the IV to drop off entirely. But you could probably do better than like 7 days, maybe like 2 weeks or so. 15's a little higher than I would probably buy Upstart right now. Like that's the high end of where I would buy it. I think it can go back to like 12, 13 again. Is it worth playing RUT or IWM for a March April dip? Um in a contracting macro environment, mid caps could do better. I probably wouldn't play the downside, but if we do get a big correction, I would probably play the upside of RUT or IWM. So I like it a little more on the upside. I like Nasdaq a little better on the downside, and I like RUT a little more on the upside. Like those could both outperform S&P. The benefit of S&P is it's a bit more stable. It's not nearly as volatile. It has a broader exposure to like it has oil exposure, it has industrials exposure. It's a little bit better than like Russell 2000 or Nasdaq in regards to its defensiveness. Like if you think of like Dow being the most defensive, then S&P is probably the second most. I can't believe people are still bullish after SPX has been acting super weird for 2 weeks. Most people just look at the charts and get on like FinTwits, and everyone's like, I'm going long as fuck SPX at 42, and they're like, man, this guy's pumping a lot of money into the market, betting it'll go up. It must be going up, but that's not the case. Even informed investors with tons of money lose shitloads of money in the market every day. Longtime questioner, first time options profiter, Mr. Girk, thanks for everything. No problem, man. Fast question. I had about 800 cash left last week. I spent 500 on two March 31 380p. I wanted low risk. Other options? I mean, I wouldn't call March 31 380s low risk just because of how far out of the money they are. Um, but they're probably not bad. Just because you have money doesn't mean you need to spend it. Cash is a position as well, but I hope those do well for you. Yeah, like Tom Lee, Fun Strat, greatest trader of our generation. You really fucking hate that guy. I have no idea who he is. Also, can you touch on if you think their fear is going to stir up more as the U.S. water supply is under attack by all the unrelated environmental accidents? I think that's kind of blown out of proportion. First of all, there were a bunch of train derailments, but I think the only ones that led to significant hazardous waste release was the one in Ohio. Um, and even then, there's dilution in water, uh, especially over, the entire like, what the fuck's the name of that river or that watershed? The begins with an O. I can't remember. Like the Ohio Valley River system. But You know, it's the concentrations are gonna fall off, right? Mostly those particular people super fucked. People, and you know, as you move further and further away from it, less and less fucked. Bullish on cancer drugs in 25 years. You gotta get these people paying attention to the sector rotations. Yeah, I know. I'm working on it. Listening at 1.75x, hoping to catch up before you end the stream. Thought you would have the 40-minute intro this week, but I guess I was wrong. If I don't catch up, thanks, Gurk, and have a great Monday. Thanks, Posty. If the market does tank this week, we will, and we think it will continue, what is the smart way to change our positions to make the most of it so we don't get overly bearish? I mean, you don't have to buy like an extensive amount of exposure, I guess. I mean, I have quite a lot. I think of my free positioning, I'm like 50% of it is short the market right now. Um, a little, actually, it's a little more. I don't know what you mean by overly bearish, but you know, don't do stupid shit. Don't buy like short dated, super far out of the money options. It could take some time to drop, like a month. So, you know, position accordingly. Try to, if you're going to have shorter dated options, try to ensure that they're going to go in the money sooner rather than later. I see we see at least one day or so with roughly negative 5% at some point. From here, that would only be like a drop to 38.50. It seems probable to me. That's kind of near, well, near the range I think we could fall to. Right now, I'm looking towards like 37.65 by middle of March or after March SLD. Burke, I was gone for a few days. Thanks for all the spy put strikes and dates. I made a ton of money while not paying attention to the market. That's fucking awesome, man. Congratulations. I feel like the US could afford to lose Ohio. I feel like it's not the worst pollution issue that Ohio is dealing with right now. It might be the most concentrated at the moment, but Ohio has several EPA violation sites that are deemed hazardous, like almost more than any other state besides, like, I think Pennsylvania. All of them are, you know, have continued to fail inspections for years. So I think the moral of the story is, if you live in Ohio, get your water from somewhere else, maybe. Any thoughts to if FSLR's bull case new plants will overwhelm the bears after earnings? I took the downside play, but after reading about them ramping production, I got a tad nervous. I don't think they can ramp production, scale production, at the rate they plan to, and if they do, that's going to hurt their profit margins, right? So if they're investing in a growth cycle, that's gonna reduce the value of their stock, even if it's briefly. Their price to earnings ratio is ridiculous right now. Their margins are going to contract one way or another. Either their margins are going to contract due to the macro environment, or their margins are going to contract because they're taking all of their free cash and reinvesting it into growing infrastructure. And until that infrastructure is up and running, a lot of shit can happen. Their price will likely drop. I think I'm already up on the position. I mean, at this point, it's just the more it drops, the more extra money I get. Can you look at NVIDIA for us? I know it's become a meme at this point, as we entered after you edited and are now underwater. I mean, I entered most of my NVIDIA position on the short side on Thursday and Friday, but I'm in. I'm also short NVIDIA now. I kept telling people to wait. People didn't want to do that. I don't know why. But yeah, Nvidia is super index exposed. If the market stays up, it will too. It's a very, very large company, heavily weighted, not only in QQQ, but in SPY as well. We decided to run a bunch of train derailments in the news. They must watch the stream, and we're counting chugga chuggas too. I mean, assume that there's a motivation, right? Thousands of trains derail in the U.S. every year, but now we're talking about it all the time. How do you feel about SPX March 3rd, 39.85? Kind of risky. It's not. It's not the worst. You got a couple weeks, right? Yeah, I don't think that's that bad. I can't pick your strikes and puts for you, but that doesn't sound like an awful one. Sorry if you already covered any Fubo news or thoughts. I know they have earnings coming up. I'm kind of excited about that. I got unexpectedly assigned on some CCs for Fubo. That was weird. Especially because they were dated for Feb 24th. So getting assigned a week early on those was interesting. I still have an obscene amount of Fubo positions, but yeah, that was a bit odd. Walls may be closing in, just FYI. Input on Upstart and AMC likely to be next up to go full silent. 6 months, I won't be able to say anything at all. Oh shit. Where are you going, Gaff? Are they sending you to the front line? I filter all the water I drink and bathe with because I live in Ohio. Ohio puts the O and oh that's a super fun site. I don't know. I've traded and retraded the same option over and over again on Nvidia and have done well. I mean, yeah, there's been a lot of like opportunity to play both the up and downside as it's chopped in this upper range. But as far as like long term puts go, I haven't entered anything until recently. You know, obviously I'll adjust. You know, I'll probably rewrite and adjust some targets. I know you guys saw me YOLO into like 150 puts for or 150 puts for March. I bought 500 of those, but that's more of just a YOLO if things go real south real fast. Otherwise, it's just like a short term scalp on a small drop. They were very underpriced. Oh yeah, and the Tesla recall during market hours on the rally. I mean, fucking Elon's obviously trying to pump Tesla right now, right? There's been nothing but just like good news stories over and over again on shit they haven't done yet. That's the standard Elon pump cycle. End of March hitting 330-ish, no longer on the table. You mentioned 3700 after March SLD. I mean, that's currently what's being priced in. That can change. I never expected it to hit 3300 by the end of March, maybe June or something. Especially not after this rally. If we'd continued down in the previous like December drop, then yeah, maybe. But I I mean, my target range for SPX is right here. Yeah, I gotta delete that. Hold on. I post it every day, and any adjustments to it. But the bottom of like the end of quarter range is at like 3650. And the concentration of my positioning is all within here. Like 3850 to 3965. I do have some 3600s that are up now, finally. Yeah, super funds are a site that's being dealt with. Nor worth the headache, I assure you. Just market growth filling the vacuum. And proximity getting too risky to have public opinions, especially with the same gusto I've had previously. Interesting. Well, I won't talk to you about Upstart anymore, I guess. I never wanted to talk to you about AMC, so I know it's probably not going in the money, but grab some SPY 317, 360 is currently up around 15%. Would you continue to hold or take profits and get something closer to the money with the same theta? I mean, you can hold them for a bit. They'll continue to gain value if the market continues to drop. Just make sure that you have a moderately tight stop set on them because they can lose that value very fast on a turnaround. Are you talking about the S&P? Quite a bunch, yeah. I think of loading the boat on spy puts for May or June. Thoughts? That's a strategy that you could take. I mean, I'm bearish on the market right now. I think the market's going down over the next month. I have a bunch of $20 P on GME expiring this upcoming Friday. You think rolling them is a smart idea or just ride them out this week? I bought them 3 weeks ago. Well, we could still have an OPEX. I'll kind of get into why I think we won't. But I'm also already exposed to the long side in case we do. For SPX puts, July 3200 and March 3900. I'm new to swing trading SPX. Seems like 3200 are really only profitable with a large increase in volatility. Are near the money king for SPX, generally speaking. On swing trades, I mean, you can move into farther ranges, but you don't want to buy strikes that are too far out because you don't want, since theta is so expensive, you don't want theta decay eating your contracts alive, waiting out a long-term move. Are there any funds you recommend to park money for a downturn? No. Not that wouldn't just be cheaper. Like cash is a better position at that point. If you're not gonna have short exposure, then cash is a better position than parking money in something. Good morning. Was it safe to get some SPX 3800 puts? End a quarter, 45 days, so theta won't be a problem until EOQ. Oh, end a quarter plus 45. That doesn't seem like a terrible target range. Like I said, currently the market's, I think, pricing in roughly about 3,700, and then it could potentially price in lower over time. But right now, that positioning's not there yet. Is it too late to enter a downside play for SLD this week? Super risky. My apologies if covered already. I still think there's time to target the downside moves on SPX. Plenty of time. There'll probably be a rebound like market wide during like the ETF FTD period, especially if we get a big drop. So if you're targeting 3650 for March 31, we're grabbing in April or June 4000 P be better. Uh, sure. I mean, it's not bad if that's what you're asking. That said, if you can keep it vaguish in general, happy to still be part of the discussion and theory crafting. Okay. If it walks too far over the line, I just won't participate. That's fair, man. Let's just start with this. Market crash this week or like beginning of March? I'm wondering if you could talk more about Horizon. I find that pick really compelling for a long hold in my retirement account. I mean, they buy up debt from uh, moderately distressed companies at variable rates. They're not a very interesting play. They have a tiny bit of growth potential, especially sub $12. They have a pretty fat dividend. They're on the lower end of their legally allowed, like uh, like debt ratio. So I think if anything bad were to happen, or they get a high amount of defaults, they're moderately safe. But they're just not that interesting. They just have like kind of a fat dividend, and it's something I don't have to manage. I don't know if I'd want them long term. I don't think the growth potential is that great. But the obviously the monthly dividend payout's really nice. How long are you planning to hold? It looks like they do well in a bull cycle too. I plan on holding it until O is cheaper, and then I'm gonna put all that money into O instead. I just want something generating me money in the short term, and it can do that without a lot of management. And it's relatively defensive, so I'm not super worried about the share price slipping, especially when combined with the dividend. It's got very nice returns on like a 10-year drip if it's like a long-term investment for you. I think I shared some of the like the stats for a drip reinvestment. Obviously that gets better the more money you invest. Is buying shares in something like SPX kind of a downside hedge? I know you're not really supposed to hold the shares over a day, so that's why I'm asking. I mean, you can hold them more than a day. The volatility decay is not that rapid, but yeah, I have a bunch of SQQQ shares right now, so you can hold them for a period of time. You don't want to hold them into their like splits, and you don't want to hold them for too long. But they can be a short-term holding that allows you to hedge the downside. Pickles picks tomorrow night, probably. More information, the better. Safe to assume I'm not telling you to YOLO into Doge, then I have no insight there. Doge YOLO is the safe word. Okay. um, anything you're excited to enter this week or you'd like to discuss your thoughts on? Nope. I'm just buying puts. I mean I'm mostly just short the market right now. I'm waiting to sell more CCs on GME. I've got the CCs out for Upstart that I wanted to sell. If put skew starts to pick up, I'll probably start selling some CSPs on GME and Upstart. Not yet. I think right now is not the best time. If you guys, that is something I did want to weigh in on. If you guys got assigned last week, which means a couple things about you, which I'm going to say out loud. Don't be embarrassed. It happens to everyone. But if you got assigned last week, I'm going to assume you did two things. You sold short dated CCs in the money or at the money. And then you took the credit and blew it on speculative plays, leaving you with the inability to roll your position out further. Don't do that. That's bad. Hold on to your credit if you don't have the cash to roll your position, because you'll need it to roll your position. So but if you did get assigned and you now are cash rich, and remember that cash is from your long-term holdings. It is not there to gamble with, right? That would be very irresponsible to gamble with that money. You can then just start selling CSPs at or at a lower strike than you were assigned at, and start picking up premium on the other side until you are assigned and you're back into your position. Being afraid to sell your CCs at the money or out of the money is ludicrous, right? It's just capital in one form or another, right? You're either liquid in the stock, you're liquid in cash. I mean, you can just flip it back and forth. Don't panic. Jamie will probably go down at some point, and probably lower than what you sold at. But you can just start selling CSPs at the strike you were assigned at, or at a lower strike if you think the price will go lower than that, and simply wait until you're assigned again. Or you can sell CSPs on a company that's better. Slagathor, but Jamie isn't bad for a recession. Slagathor, guh. Thank you so much, man. I appreciate it. Is that a green banana? That's a lovely emoji. Some April UVXY 7C. Do you think that's enough time or roll on a spike? I wouldn't play UVXY or VXX. They're ETNs, and if VIX were to spike hard, they've had a lot of problems in the last year. I don't think they're properly correlated with their like underlying like asset pools anymore. So they're generally not a good play. They're also daily return multiples, so they have like a compounding growth effect if VIX continues to drive up. I've been looking at BGFV for a few months now. It's also got a nice dividend. It's probably going to get beaten up a bit in a recession. But do you think it could be a decent value play if cheap enough? I mean, I probably can't say because I don't know enough about it. Oh, this company's like kind of dog shit, right? I don't know. Look at their free cash flow and their debt. Maybe try to like do like a DCF valuation. I mean, I would never buy their stock, but they do have a good yield, which is surprising. I don't know who the fuck shops there. That place is disgusting. Hey Greg, I have a decent position on 49.25 SPX for Feb 28th. If we don't see downside in Tuesday, Wednesday to at least 40.50, would it be best to close my position and roll into the end of March? Cheers. You have a position at 49.25 on SPX? Are you smoking crack? I think I'm at 40.25. 40.25. Okay. I was like, Jesus fucking Christ. For Feb 28th, yeah, you could close and roll. I assume you're up depending on when you bought in. If you bought in on Friday, you're probably not, but if you bought in on Thursday, I would say that you are. Um Break even. Okay, so yeah, I mean, you've probably got a day or two. The over the weekend theta is gonna hit you kind of hard, but you probably have a day or two to roll. My upstart CC's got exercised early. How common is that? Some of mine that got exercised. I had some weird exercises on Upstart. I think I got a couple CCs exercised that were for March 17th expiration, which was strange. But you know, it has liquidity problems. And then I had out of the money CSPs exercised, which was someone sold me their shares for less than spot. I think that might have had something to do with like the big bounce from earnings, but I'm not really, and then like just the delay in settlement, but I'm not really sure why the fuck that happened. I'll try and do my first DCF valuation on them. They made a decent amount of revenue earnings in 2021. Maybe as a result of the pandemic. I don't know. It's been trending down ever since though. Yeah, I know at one point they were more correlated with like the rest of the basket stocks. They still seem to have some correlation. Their dividend's nice, but I think the company itself might be a little risky through a recession, especially if their revenues continue to decline and like commercial real estate prices continue to stay up. Rolling a CC would imply that you sell another call in order to get enough premium to cover the loss over selling the first CC and have some more premium left, generally speaking. That's if you have a margin account, but if you're in a cash account, you need to have the money on hand to buy back the initial calls first because you can't sell naked. All right, let's see what Dork and JFresh are up to.
Programs in Fortran.
What's up, guys?
Oh, hey, what's up? We're just talking about programming languages.
Oh, fun.
So fun.
That sounds so exciting. All right, so who wants to go first? Who wants their moment in the pores spotlight?
Well, do you want to talk about SPX or inflation? Because I have a pretty good inflation thing going on right now where I could sort of go over my thesis as to why either inflation or rates are going to continue to go up.
Okay, sure. Yeah, tell us what the inflation rate swap, like the inflation swap speculators and SOFR players are betting on.
And explain why Peruvian bull is correct and hyperinflation is here.
Oh God, I
Oh,
don't know about that.
gross.
But so in the chat, you could see above the discussion Cornum and I were having, I have like six charts.
Okay.
The bottom three are kind of the ones I want to talk about.
Okay.
Uh, and
Bottom four.
bottom three, there's three lines on them.
Okay, the Fred charts. Oh, I see. Okay,
Yeah,
I'll
yeah,
I'll
yeah.
start opening these up.
Yeah, I think these are pretty important when we are when we want to discuss sort of how effective the Fed funds rate is in controlling inflation. We need to look back as far as we can and sort of see what similarities we have towards different periods.
Mm-hmm.
So the top one is, let's see, I'll wait for you to have it up so chat can follow along. There it is, cool. So the top one, yeah, so this is just a long period of velocity of money, sticky CPI, and the effective Fed funds rate.
Mm-hmm.
And you'll notice that the velocity of money has been in like a downtrend for the past 25 years approximately. But another thing you'll notice is that when the velocity of money is high, at least in this chart, which I mean has limited data to some degree, but when the velocity of money is high, that means that there's less money chasing goods, which means the price discovery is a little more effective because the market is more illiquid, well,
Mm-hmm.
the economy. So that means that when the velocity of money is high, the effective Fed funds rate is more effective at bringing inflation down, especially when you bring it above year over year. However, the velocity of money being so low now you'll notice sort of in that downtrend that each time the Fed funds rate was increased, the effect on sticky CPI was lessened.
Yeah.
Ever since after the 70s, and especially after QE, the Fed funds rate doesn't do anything to really to inflation
Hmm.
necessarily. So, the next two charts, one of them's zoomed in on the 70s, just sort of illustrates this idea that the velocity of money is loosely correlated to how effective the Fed funds rate can affect inflation. Once again, bringing the effective Fed funds rate above inflation it will be effective at bringing down inflation. But as velocity slows, that effect is sort of lessened. Um, and then the final one is zooming in on now, where we have a super low velocity of money. And you'll see that the inflation just started, going up. Mostly because of Putin's invasion of Ukraine and everyone freaking out and buying stuff. But what I think this means is that because we're not bringing the effective Fed funds rate above year-over-year inflation,
Hmm.
if anything, it'll probably just start to peter out a little bit until another stimulation happens to the commodities market or something causing inflation to go up. At which point the Fed will have to decide whether or not they want to continue to raise rates aggressively or not, right?
I mean, historically, the Fed's fund rate isn't very high right now.
Right, it's not. But so the conclusion I'm kind of getting at is that the Fed really needs a significant increase in either the velocity of money or the Fed funds rate if they want to get inflation actually under control, not just where inflation's doing its own thing and being damped around by the Fed funds rate. So they're either going to have to increase the Fed funds rate a lot,
Hmm.
or they have to go slow and let inflation drive until the velocity of market gets high enough that they can actually have an impact on inflation, right? If the velocity of money goes up, which it's sort of going up a little bit,
Yeah.
until it gets up a lot more, inflation is not really going to be super well controlled by the effective Fed funds rate, unless they bring the Fed funds rate above year-over-year inflation, which, it's only a correlation, but it seems to be highly effective at bringing it down.
Yeah.
But they'd still have to hold it for a while at
Yeah.
that
That,
rate.
so I mean, I've kind of looked at this. Well, similar effectiveness charts from like the Volcker era, and yeah, I agree that their best bet right now is probably to bring the Fed fund rate over inflation. As it was cooling, that would have been a very good time to do it. Now that it's starting to warm up and we're starting to get like more volatility in that data point, it's concerning because if the inflation rate drives higher again, especially with China reopening like into the 8% range, then the target range for the Fed is going to have to go up like drastically in order to meet that goal, right?
Yeah,
Yeah,
and
can I circle back a little bit on the velocity of money? I want to make sure I fully understand what the theory is here. I mean, I kind of thought that the decaying or dropping velocity of money since the 1990s to now has been sort of one of the things that has allowed the Fed and the government to pump so much stimulus into the economy without seeing inflation because the money goes in and keeps things afloat and it just stays at the top and doesn't do anything, right? And it's not being circulated to drive up demand. And so
so
seeing this little bump now is actually pretty concerning because it's showing that the movement of money is increasing in the economy.
you're correct. But so you have to kind of consider the economic situation, pre 2008, post 2008. Pre 2008, in like 2000, there was real economic contraction happening, which was reducing the velocity of money. Post 2008, it was purely quantitative easing that was reducing the velocity of money because it was increasing the M2 money supply, right? You have to see whether or not it's a growth in GDP or it's a growth in M2 money supply. Sorry, a decrease in GDP or a growth in M2 money supply. So post or pre 2000 or like during 2000 in the dot-com bubble, GDP was going down, causing the velocity of money to go down. Post 2008, GDP, during 2008, GDP was going down, but post 2008, GDP was staying fairly flat, going up a little bit. But the supply of money into the economy was going up, the whole time. So that was really what was causing the reduction in the velocity of money. Um, so yeah, and because the velocity of money was going down, they were able to continue pushing money into the market. Where you have more money chasing after the same amount of goods, that means less money is going to be circulating.
Right. Oh, I see now. So this, I didn't for some reason, I didn't realize this was a ratio. So it's going down since 2008 because the total amount of money has been going up, but they've been giving it all to banks and the top who just don't do anything with it. They just sit on it.
Yeah, exactly. Yeah, it's the
Yeah.
tail wagging the dog situation, where this looks like a sign of economic health. However, it's purely created by QE, and you could see the massive dump in 2020 after QE rolled in again with extreme vigor. So yeah, the increase in money supply the increase in the money velocity at the end is concerning because that means that the economy is more vulnerable, but that's kind of what the Fed wants. They want to reduce the money supply, and they are, to some degree, which should, in theory, make inflation more sensitive to the Fed funds rate. However, it's at such a low point that they have a long way to go before the velocity of money makes it tenable for them to bring such high inflation down, especially with the Fed funds rate below inflation. I mean, I know it's not below it month over month, but year over year, especially for something that, really is a slow reacting parameter like inflation. I mean, month over month, it'll do things, it'll be volatile, but year over year is where you really see sort of the effects of the Fed funds rate come into play. And
Yeah.
I guess I'm
Well,
going to go to a 6 month frame, but I mean, I don't know. I still think year over year is probably the best thing to look at.
um, yeah. Well, what's interesting about 2020 is that the stimulus was given to regular people, right? And so
I mean,
uh, they
yeah,
spent it, right? And I think that's what that trend up uh, in 2022, because I don't believe quantitative tightening didn't really start until June of 2022. Is that correct?
Yeah,
I mean, you can call it starting, but yeah, you theoretically
barely.
or technically, yes, yeah, it
Yeah.
did.
So I think that little blip is not necessarily so much a decrease of the denominator of total money, but an increase of the actual velocity because we gave the money to the poor's, which was mistake number one, right?
I mean, we only gave them like 5%. We only gave them like 5% of the money. We didn't give them a ton.
Forgetting all the
Yeah, well,
PPI loans that got used on new sports cars.
I mean, I'm
Yeah,
being a little facetious, right? It's fashionable to blame everything on the poor and then take credit for all the good stuff that the poor's do for society. But yeah, so I think, and unfortunately, this is obviously a delayed indicator, and we can't see what's going on now with the money supply or with the velocity of money. But I suspect that most of the money that was given out
Shut the
is
fuck up,
long
Stefan.
gone. What's he saying?
Oh, just stupid shit about the euro dollar. First of all, the euro dollar is counted in the M2 money supply and the overnight repo operations. Second of all, it's still smaller than the fucking dollar economy. It's like 10% the size of the dollar economy.
yeah, euro
Jesus
dollar can get
Christ.
fucked. Euro dollar is basically dollar. You just look at the dollar, and the euro dollar is the same thing.
Yeah,
He's
that
been
sounds
watching
like
too
an
much
argument.
YouTube again.
Sounds like an argument I don't really care to
Yeah.
entertain. But yeah, so it'll be interesting to see, where I mean, obviously the velocity of money will increase then, as you say, because they're actually tightening and pulling money out. But that it'll be hard. There's just not enough information in that velocity of money by itself to really disentangle, whether it's due to spending or less money. I kind of hate this now. Why split them out? Or why include them together when there's so much more information when they're split out?
I mean, it's supposed to be sort of like a quick reference to both GDP and M2, which I mean are pretty strongly linked. And The increase in the velocity of money is sort of, I think, why Burry is so bearish. I think he thinks that when the velocity of money increases at a rate higher than we've seen for the past roughly 20 years or so, um, it's going to create economic sensitivity that, especially if the Fed continues to tighten, could lead to a crash of some sort, or at least a recession, right?
I think the inevitability of a recession is kind of already locked in by the rate increases that we've already seen.
Yeah, I will say, I was, I've always tried to play the bull case on this for a variety of reasons linked to mechanics and sentiment that we can never really predict and control. Bulls are always exist, and they always seem to push a little harder than anybody thinks that they possibly can. But yeah, I'm starting to get to a point where it's hard to ignore all of this stuff, right? I mean, the idea that this will resolve itself by the end of the year is certainly still a sentiment that a lot of people feel, and
It,
that could push them to buy the dip, right, as they've been doing. But I mean, there's so much money now pushing the other way, and there's not really any mechanistic leverage for the bulls that they've been enjoying since December. So
Well,
yeah, I don't.
it's been dumb money throwing money into the stock market because inflation's been going down. I mean, you saw retail investors have come back in force. So it's literally just people seeing CPI go down, buy stocks, and they're not looking at the bigger picture. Things like credit delinquencies, and treasury yields, the inversion, those sorts of
So
things. They all
some
still
of
pay.
that's a little bit out of their control, though. Like I mean, I know that they like to call it dumb money, but I think a lot of it too is just passive money, right? I mean, a lot of people, most of their money they have in the market is tied up in 401ks and other retirement instruments, right? And they just are sort of a set it and forget it, and money gets dumped in. They have limited choice as to what they can invest in, and so a lot of times they're choosing between various ETFs or bonds, right? Um, and so there's only so much active management that really can be done with all that passive money. There's just always money being pumped into the market, just because the way that society is built, relying on the market for decades of living, right?
Well, I'll counter that by saying that it's a shift in trend. But I also want to point out too that, a rate cut is still being priced in. Um, and a rate cut doesn't happen because things are just so awesome that we're going to cut rates because everything's great. That's not how rate cuts work. So the market is actually still pricing in, ironically, through the rate cut, a recession happening or something breaking, right? Bulls think that pricing in a rate cut is bullish, but I mean, you can't you can't have your cake and eat it too. You can't get a rate cut and have a bull market happen unless something was about to break.
Yeah, keep discussing. That's interesting. I'm gonna do a little programming here and pull out the what the options chain thinks the rate is supposed to be going into the future. So give me a minute.
Okay. Well, I mean, that's pretty much it. I mean, I've laid out most of my bear thesis, but I do think that rates are headed higher. Uh, I don't know by how much, but the target rate where it's at, I think, especially if inflation doesn't go down significantly in the next quarter, which I mean, it seems like it might not. I think that rates the target rate's going to have to go up, or or the Fed might have to actually raise its inflation target, but they've fought that idea tooth and nail every step of the way. So I don't think we're at that possibility yet.
I
The no
wish we
landing
had
scenario.
more CFTC data, because I think a more accurate way to measure the flow or velocity of money in like this scenario than the M2 supply, which the Fed does track, and there's a part of Stefan's rant that isn't incorrect as far as Eurodollar goes. Like, more dollars are created and destroyed in the Eurodollar system than anywhere else, right? But the Fed doesn't really, they only monitor Eurodollar through overnight repo operations. Would probably be to like look at like multi-currency swaps or swaptions, credit default swaps, and like currency swaps, which may be a good reason to monitor like FX forwards or like euro dollar futures in
I mean, you could also measure
terms of
credit
seeing where
spreads
the
as
money's
well.
spent, right?
You could also measure credit spreads as well,
Like
to
looking at like
see.
the M2 money supply in relation to like the consumer price index, for instance. So
Yeah,
we can see
I
like
agree.
where the money's going. Is it being used to pay down debt? Is it being used in the stock market?
Yeah, there's
Just for your own research, it might be something to look at.
yeah, I've looked at a few of these things. I've never tried to create a function of money supply to CPI to. But I've been thinking about doing something relating to GDP and private debt owned and securitized, as well as corporate debt. Um,
If we had swaps data, we could get probably a much clearer picture of all this. It's
oh
hard to
yeah,
get.
like swap volume. Oh, that'd
Yeah.
be that'd be a great indicator.
You guys want to you
Uh,
guys want to pick up a Bloomberg terminal?
yeah, let me just dig
Maybe
up
we
my
could get a
own
used one.
yeah, on Craigslist.
Yeah.
Maybe Gap
Um,
has one laying around we can buy.
So yeah,
so
I agree. The limited insight I have into uh inflation swaps tends to agree with your assessment that the Fed not only needs to target a higher rate, but that they're going to. I think our last round of data really doesn't give them an option. I think the market's starting to realize that, and with that, contraction in margins are guaranteed, and I think that's why we're starting to see long interest after the risk-free rate started to stabilize, as Jay Fresh pointed out many weeks ago. And I will just note that that was very profitable for anyone that listened. I think now that that has started to stabilize, we're seeing longs just bailing. They're going to start bailing out of everything because the forward returns are no longer worth the holding period.
Yeah, I mean, the equity market has just stayed so disjointed from the bond market ever since the CPI print and especially the PPI print. Like,
Yeah.
there's no way equity prices don't correct. I mean, at least 500 basis points to the downside, but probably more as an overreaction by the bears.
yeah, so I'm looking at the risk-free rate that the SPX options chain is pricing in, and it actually looks like it's slightly sloped upwards up through about next February. It's very small though. I mean, from now till then, it's only pricing in like another 0.25 increase that would persist until February, and then after that February, it just starts dropping off. It drops off over the next year by like 0.75 and then just keeps going after that. So and that's people making bets, kind of based on, some of that later on in the later years is going to sort of be an averaged out over time rate. So that means that they're expecting, by 2 years from now for inflation to be dramatically lower, which might be true. But at year one, that's starting to become questionable that it'll have
Well,
only gone up by 0.25, the risk-free rate, and then we'll start dropping. This
That, that's
last
fair.
PPI data point sort of uh, really made my bull thesis that I sort of devil's advocated for pretty shaky.
well, I
That's
mean, there
bearish
was
to me.
your bull thesis was timed well, at least. The long-term bull thesis, I mean,
The
maybe not so
long
great.
yeah,
Yeah.
so the long term bull thesis I think was just my attempt to make sure that people weren't. It's obviously, the obvious choice is that the market should go down, and I just wanted to make sure people were scared enough about the irrationality of the market that they wouldn't just all full port puts back in December.
Yeah, like a repeat of August.
Yeah.
I'm very happy to be full porting puts now, though.
Yeah.
This
I
is a
mean,
much better time to be full porting puts.
Do you wanna talk about charm exposure and it now falling off and how much
I
that was
do.
influenced by
Uh,
the 4100 strike?
so at a risk of for those of us who try to reverse engineer everything we're doing, yes, I would like to talk about charm. I think that's out of the bag now. So, I've been showing that SPX VIX correlation since December, and showing that there was what appeared to be a lot of short calls on the chain everywhere. Someone trying to go short volatility and be on the positive side of Vega, or sorry, not Vega, Theta, so that they weren't the timing was less critical, right?
Yeah.
And the market was able to sort of the bulls had just enough juice in the tank to turn that around enough to cause it to start unwinding, which is why we bled up from December to now. And then about a week or two ago, right when that sort of gap closed and there weren't very many short calls left to sort of perpetuate this upwards, um, we had a new phenomenon. Now we had enough bullish bets in the money sitting on the chain, that over time the market maker has to naturally hedge those as time progresses, and the reason for that is measured by charm. But the idea behind charm is that if you look at the delta of an option, if you go and buy a leap today, you can get a pretty decently out of the money leap with quite a lot of delta, right? Up to point 4, even if it's quite out of the money. And the reason for that is because the volatility is so high, so uncertainty is high, so delta is spread out, it's smeared out. But as you approach expiration, that that delta spread starts to compress, right? And then right at expiration, everything in the money is a delta of 1, and everything out of the money has a delta of 0. So what happens is if you have a lot of options that are in the money, as you progress towards expiration, their delta is naturally increasing, which causes the market maker to have to hedge that. So if you couple that with the fact that gamma is negative, right? As they're buying to hedge their delta due to charm, that buying pushes up the price, which pushes on their gamma, which causes it's
Yeah.
literally like a charm gamma squeeze kind of thing. But it wasn't, obviously it wasn't a squeeze, but
And now that the $3 billion of 4100 calls at 40 well at 4100 are closed.
yeah, so the charm is mostly gone now. And so that's not to say that they can't build it up again, but I think at this point, I mean, you'd have to buy so many more in the money options to revamp that call ramp. That's not, if we keep going up, that's not going to be the reason why anymore.
Yeah.
So we're kind of at this point where we finally now, after everybody's been waiting patiently since December, for this market to turn down, we finally are getting to a point where the bulls are losing their mechanistic advantage in the market. And so now if they want the market to go up, they're just simply going to have to outbuy the bears. And we'll see, right? I mean, bulls buy. So yeah, I bought a bunch of puts. I'm ready to go. I just started shotgunning strikes from like 3,800 to up to about 4,020 or so, from like between March and May. And
I don't know if Dork showed you this, but we were looking at the performance of all the stocks in the S&P 500 during the period following August SLD into the drop that went on into October SLD. And there were some interesting names in there. This may drop harder than the market.
Yeah, I seem to remember
I
like
might have
we were
gone
looking
excessively short one of them.
at Nvidia.
Yeah.
Yeah, we were looking at the biggest winners and losers during that drop post August, and Nvidia was one of the biggest losers. There was a few more as well, but
AMD
it
was
was
one.
yeah, AMD was
Chip
the tipping
sector
point.
was a pretty big loser through that period. That also may have had to do with the that was around the time they announced the
The China shit.
yeah, the embargo, well, it's not embargo, but the executive order banning the sale of chips to China.
Yeah, I think that tech is going to have the farthest way to drop, just purely based on which sectors have been outperforming since the beginning of the year. It seems like tech has been
I think in a market
getting
drop right now,
overlooked.
people just don't have faith in tech.
Yeah,
Yeah,
exactly. I
and
mean,
Well,
really.
that
tech also one of the biggest pumps in the last month, right? I
yeah,
mean, Nvidia has gone up far more than I would have expected. Tesla too.
I mean, I think this is perhaps a blind spot that we currently have because the Nasdaq options chain is so much smaller than a lot of other things that we haven't really been tracking it. But there's certainly been some effect, of this pump in Nasdaq that has sort of influenced the larger market as a whole. I mean, I just been watching like AMD ticker, and it goes up like 3% one day, and then it's down 3% 2 days later. So there's some extreme volatility there that may be spilling over in ways that we haven't quantified, and that's something. Again, as somebody who's always worried that the bulls aren't done yet, I mean that is something that is worrisome to see so much risk going into tech, right? Because tech is really considered, sort of the risky bets with the most lofty PE ratios.
Yeah,
I
And then
mean,
also, Bitcoin just tried to push up past 25,000 today. So,
so
I mean, there's money coming in from somewhere. Somebody's bullish. I'm not quite sure why, but they are.
so this might be, this
this
kind of
could
comes down
like the
to
Bitcoin pump could still be an effective SLD, right? Risking on in order to increase margin parameters, going into leveraging short side. Don't forget
yeah.
that like the larger amount of leverage for market direction is going to come this week as SLD settles out.
Yeah, I mean, certainly you could be correct. I don't know what it means that Bitcoin's pumping. The easy answer, the most probable answer is because people are pumping money into it because they're bullish. But certainly there could be other mechanical reasons for that to occur that aren't bullish. But I'm not aware of them and I'm not tracking them, so I can't. It's a point of uncertainty and risk in the analysis because something's occurring that looks bullish and I don't have the data to say it's not, right? So that's just a point to consider. Um, yeah, we'll have to see, but for the most part, it looks like the advantages that the Bulls have enjoyed for the last few months are gone, and maybe we'll find another one this week. Who knows? But uh, I don't see one that's super glaring.
So to point out the tech rally, at the same time, crappy stocks have been rallying as well. It all points to sort of like a rolling of some sort of positioning in preparation for a long side sell off of sorts. So ETFs have been performing really well. They've been more volatile than the SP than like their actual indices though. And I think what we've been looking at with our charts too, with the squiggles, is sort of a shift in
Ooh,
liquidity in the positive direction,
ooh, I can
right?
open. I have that.
There we go.
Hold on.
So, I think what's happening is uh, people who want to create shares on the underlying are sort of loading up on ETFs so that they can get those creation baskets when they need them if they haven't already been making them. Which, when you do
Well, you
that,
can
it causes
if you
the index
expect
to
the
correct.
market crash to crash, right? You can you could create a shitload over the last, let's say, since December 28th, right, when we really start to see this skew away from, the market action, and then redeem it all afterwards.
Exactly. Yeah, it's
Yeah.
exactly what I'm saying. Yeah. So I think that part of this push, I mean, it was a lot of it was one or 0 and 1 DTE pressure, but I think a good portion of it as well, sort of like that a positive feedback loop, was shares being created to satisfy long positioning through ETFs, and that it increases the volatility of the index to the downside when all those shares need to be redeemed. So especially with index options. So yeah, it's certainly interesting, and I think it kind of comes full circle to the BTC idea too, which I think the run in BTC, you think it's bulls throwing in money. I mean, technically it is, but the reality of it is that in terms in terms of like actual global popularity of BTC, running at this amount of percentage, I mean, with regular folks or small funds, I think is just really it's unrealistic to have it run this much unless you just had like people going crazy bullish on BTC, and I don't think they people necessarily are.
So
But
I've been looking at. I was actually looking at some of the correlations there with the tools we've been using between like the the market pump, the BTC. I think some there's like some effect of BTC uses leverage. I think people forget how small of a market crypto in its entirety is. Um, it's the whole crypto market is worth less than Apple, right? Which is only 6-7% of the S&P. So it's relatively tiny. But also there's a halving, right? Is that right, Gaff? Anyway, there's a
Oh,
halving going
right.
on. I'm
Yeah.
not I'm
Because,
not going to make any
yeah.
comparisons to Dogecoin pumps, Nicholas Hong, and GME pre-squeeze events.
Yeah. I'm
Um,
definitely not a crypto expert, but yeah, I completely forgot that Bitcoin is a deflationary currency.
but I do agree that the current pump on Bitcoin is a bit excessive. I will say though, what seemed to be interesting was that liquidity was rapidly drying up in all these like larger index ETFs like QQQ, SPY, DIA. Whereas market liquidity was increasing, right, which would infer that synthetic shares are being sold short market wide everywhere, right, or being returned market wide everywhere. So if longs began recalling positions near the beginning of the year, I'm trying to figure out what the incentive to not satisfy those recalls with created shares would be.
I think that'd be the best way to do it because when you satisfy them with created shares, you don't affect the volatility of the indices.
And we talked about kind of like a pump in the market for a pre-crash pump, right, like an informed investor pump that would occur. And if you look at the trend like here on the daily especially, from like the beginning of January, we moved significantly away from like the standard growth trend of the S&P, right? The returns in this period of time are outrageous for like what is essentially like a month and a half period, right? And meanwhile, we see illiquidity in primary index tracking ETFs drive up to levels that we haven't seen ever, which is not
Yeah.
too different than the period just following March, and also not too different from the period at the peak of August. So I think we have. I don't know how rapid the downside would be, but there's definitely a significant amount of downside in store here as the realization of the sale of those securities moves forward, right?
Yeah, and I mean, you could see it in the sell-off. I think it was on Thursday, too. I think that was sort of the ETF liquidity machine sort of getting broken, and or maybe not breaking, but you know giving way in a sense, where you did have sell-offs on mega caps and all these things actually, poking through and not just bleeding in over the course of a day. I think there's been a lot of prep work, especially after CPI print, but even before that, to a decent degree. There's been a lot of prep work being done. I call it prep work, but it's movements that are happening, that aren't, immediately obvious, towards, ironically enough, towards the actual underlying stocks, which is, that you could see it as bullish because it's an increase in volume, but the reality of it is that could be, ETFs buying in, and like ETFs buying in and becoming exit liquidity for someone who, like, an authorized participant of some sort.
Yeah.
And I think that's what we're kind of like getting at overall, is just that this is probably ETFs buying in because their assets are going up, because people are getting creation units ready. That's the kind of prep work that you would do if you're expecting a large sell-off, and
And
having ETFs with a high amount of assets
if there's
is
like
good
one
for
thing that
liquidity.
I would like leverage this stream into would be like I think more people in the general population need to understand how prepared for crashes informed investors are. Even in '08, right? Like, and we were looking back through our data the other night and kind of discussing this, and it's really unfortunate for the average investor how prepared institutions are for crashes versus how prepared they are, right? Since they invest primarily on sentiment, institutions are investing on data. They are far ahead of the curve, sometimes like a month or 2 months ahead,
Well, especially when
positioning
they're
into
responsible for crash
crashes.
too.
So
Like,
it's
if
it's
you're gonna be
what's up?
I'm just I was just saying, if you're the one responsible for the crashing too, I mean, like, that's having that much information in itself makes it, invaluable if you have control over the timing, right?
Yeah.
And
Yeah, you know when they're sending Tom Lee and Kramer and now Scaramucci to say this is a bull market, that they're getting pretty close to unloading their bags.
Yep.
fucking
Nothing like
Tom
the
Lee being,
Fed saying that inflation was transitory and then dumping all their shit at the top.
yeah,
Yeah, I
exactly,
know.
right?
Imagine if we had all just sold our equities and went bearish the day that J-Powell did.
Right? Yeah. That would
Yeah,
have been awesome.
they
And
they
we
they ethically deleveraged, right? So they could be in compliance with ethics rules, right? That's what they were doing.
Well, ethics rules that they made up on the spot.
Right. That's the point. Yeah.
They
You
didn't
said
want to.
you
They
said
didn't
the
want to. They didn't want to spend the next 2 years working with any bag holders.
Yeah. And
yeah, that's true.
I mean, and
Would
now,
you?
like,
No, absolutely not.
No, it'd be awful.
Yeah, it'd be like
It'd
the
be
Discord.
yeah,
Ah.
it'd be like the Discord. Yeah.
uh, yeah, and I mean, J Pow rolling in and saying disinflation 100 times,
I'll say
and then
this
PPI
much. I'll
coming in
say
hot.
this much. It looks right now very much like informed investors are getting ready to sell their shit.
Yeah,
Lots,
I'd say
lots
so.
and lots and lots of their shit.
On the share side, like, that's the thing,
So
is like, it's
don't
not the options
don't
market
be
we're looking at. We're looking
uninformed.
at transactions.
Yeah. Link to
So
Fed Discord.
you got to be Pontiff to get the link to that one. Yeah, I don't
yeah.
know,
You
man.
I
guys.
mean, if that's the case, I'll sign up for Platinum.
Oh, right. Yeah, I'm pretty bearish. I
My guy only
mean,
makes 200K a year. How do you expect him to survive? That's fair gaff.
what does an egg cost nowadays? $10?
Yeah, something like that.
What could one banana cost,
I had
Michael?
a
$10.
3 egg omelet for breakfast this morning, and I've never felt so aristocratic.
Uh, yeah, I think that, short term we can be bearish. Long term too, I think that the bear case is still the one with more support, especially with the consumer still weakening. You know, we talked about the media talked about
Primes did get caught off guard in 08, but I'll show you that in a second.
but
Sorry, Dork.
I was just saying that you know the the credit delinquencies and private debt going up by so much in Q4 really sort of tells you where the money came from for the big spike in retail sales that seems to be improving everybody's sentiment towards the economy. So it's sort of like a neutral readout if you look at it that way. And the velocity of money explanation sort of implies to us that inflation is not going to necessarily come down in any meaningful amount year over year until we get less money chasing after the same amount of goods. And we're starting to get that, but until you see an improvement to pre-2020 levels, I mean, the case just isn't there for inflation to come down in an amount of time that would be a soft landing.
So if you want, yeah, so you're not wrong, Mike. Primes were not prepared or as prepared. The information was disjointed. Some were far more prepared than others for the '08 crash. But yes, the amount of preparation was significantly less than what we're currently seeing or what we saw for the COVID crash.
Yeah, the thing was with 2008 especially, that's one of those situations and we touched on this in our last discussion about it, was that when you're about to do something that's going to potentially ruin relationships with other institutions and things like that, you do keep them in the dark. You do not tell anybody anything, you know, when something like that's about to happen. That's sort of, you know, I think what happened in 2008, especially like you know, when you listen to like the interviews and stuff about people who did go short or get those credit default swaps, you know, the banks were refusing to reprice them even as delinquencies and defaults went up, uh, like denying that they were correlated and things like that. Like that kind of stuff, you know, I think happens when a crash, like an actual financial institution uncertainty event is about to happen, especially in 2008 when QE wasn't really a thing. No one knew what the Fed would do in response. Like, you do want to keep the information close to the vest. I mean, this time around, I think that there's a little more collusion. I don't know if that's necessarily the right word because I don't know that, like, the legality of anything, but the amount of communication that's happening in terms of sentiment and stuff, I think is a lot higher because the certainty of the Fed response is a lot higher as well. But
GC,
other
the
than
American public, like me, has been saving their credit card runway for exactly this time. Unfortunately, they haven't. Most people have been. Have you looked at the consumer spending report last month? Everyone's out buying as much shit on credit as they feasibly can. Also, the Fed is ensuring that that runway is diminished by raising rates into people needing to use that safety net. Most of those credit cards are variable rate, and as the Fed rate goes up, you know you'll be paying more to borrow that money in the future than you would have paid if you'd already borrowed it.
And even to that degree, I mean, the Fed rate doesn't necessarily have to go up for your credit card rates to go up. All that needs to happen is credit spreads need to go up.
Yeah.
Yeah,
So
and I will say, I mean, your own personal sentiment and the sentiment of people in this community is not representative in any way of the broader community, right? I mean, we are always going to be more we're always going to have greater financial means and more financial literacy than the average person. So just because you've been saving your credit card uh, runway, right, for potential hard times, most people don't really have much of a choice, and they sort of just use it all the time, and they're always paying, right? I mean, there's credit card, you know, they don't give us credit cards and basically pay us to use them unless somebody else is paying them to use them, right?
I'm actually working on a white paper right now called the half square fallacy. Anytime I think that the average consumer is more informed or fiscally responsible because I or we as a group might be more. So I remember that Half Squad exists. I remember that he's paying his rent with his credit card while YOLOing weeklies on GME, and that helps bring
Squirt,
me back down to earth.
Half Squirt, if you're here and you're listening right now, sue that priest. Do it.
Sue the
Just do it.
priest, man. Sue his insurance company for money because you're broke.
So the one bearish indicator I got too in the credit market was Apple is tightening down on their standards for buy now, pay later. That was interesting to me.
You no longer qualify with a 500 credit score.
I mean, I don't know, man, but
Amazon's gonna go out of business.
I know,
Oh
right? Yeah,
God.
I know
yeah.
someone.
Apple.
I know someone who told me recently. This was like over the weekend. I was hanging out with someone who told me that they purchased toilet paper during the pandemic using a firm off of Amazon at a price of like $50 a 12-pack and are still paying down the loan.
Oh my,
Oh my God.
what are you doing, America? Oh,
I completely forgot about that shortage. I was so upset. I need to get a bidet.
American dream.
Yeah, I'm looking at consumer credit because they did just release December, what, 2 weeks ago, a week and a half ago.
it was a massive jump.
It looks like basically through 2021 and most of 2022, consumers just absolutely pumped their cards, and now credit's drying up and they can't get more, and it's dropping really fast.
Yeah.
Like new credit debt is dropping really fast
I
because
mean,
people are maxed out.
I just
Nobody's
went to
giving them
go.
anymore.
I just went to go buy a car recently, right? And my options were pay cash or finance at like 8.75. And I have money, right? Like I'm not I'm not trying to brag here, but like I like getting the lowest possible rate on a car loan is not a problem for me, right? But that's 10% at like near perfect credit with tons of money, right? Like there's no default risk with me. And like I can only imagine other people like middle class, upper middle class people going out and financing cars right now with like $1,000 payment
Oh
Oh,
yeah. I mean,
holy cow.
on like on a car that's not only you know like 30 grand, right? So you got like $1,000 payment over like 60 72 months, but like then there's a dealer markup on top of all those cars because of the reduced inventory. So they're financing out the door like the MSRP of a devaluing asset plus a $10,000 markup on a depreciating asset. So even they'll be underwater on that car for like 4 years, right?
Probably forever.
And it's eating up like 15% to 20% of their monthly income on just that payment. That's before, you know, insurance, cost of living, the rest of their cost of living, right? It's fucking insane.
Well, yeah. I mean, my
And
biggest
dealerships
crash
are sold out for like 6 months. People are pre-financing these fucking awful deals.
was they need the new car. I mean, but my biggest crash thesis is around the ABS market collapsing because over the past like 10, 15 years, you've heard on the radio these, shady car dealership. We don't care what your credit is. You could be bankrupt and we'll still loan you a car, like
Yeah, Gaff's right. Do not allow, if you guys are in the market for a car, do not allow a dealer to get you to spend a penny over MSRP. I can't emphasize that enough.
watch that video of Gergen yelling at the car dealer if you want if you want some
Yeah,
help.
not a fucking cent. Because their
Yeah, I mean,
inventories are all about to bloat so badly that in 6 months cars will be being sold 10-20% below MSRP in
yeah, I
order for
mean,
them to get out from underwater on their manufacturer financing. So if
Yeah,
you can wait
if
to
you
buy
can,
a car, wait.
yeah,
If you can't
yeah,
wait, do not pay more than MSRP.
find
I
a way to
agree.
squeeze another 6 months to a year out of your car.
Yeah, it's worth every penny. Like if I had to put a new transmission in a car instead of buy one, I would do it
Like
before I went out and
if you're
bought one in
just
this
looking to
market.
make a change in your life, go buy a really nice shirt, like a really nice one that just makes you feel like $1,000,000, and then you won't have that desire to buy the new car
Or some
just
nice
yet.
shampoo. You get some nice some self-care products, you
Yeah,
know.
go get like a $200 haircut that just makes you look like $1,000,000. That'll be money much better spent than a car right now.
Yeah.
I must say this is awesome to listen to because I did on Twitter write a crappy DD about the ABS market being the biggest risk to asset prices, and it all having to do with the used car market. Not only that, but now recently it's starting to play out where gig economy companies, their earnings are starting to look pretty dang good. You know, they're doing well, and I think the reason why is because they do not have an issue finding labor right now. So they can keep the cost of labor down or at least stable much better than the rest of the economy. Um, and this kind of tells me that the consumer is like I said employment was going to be skewed. I think I did. Employment was going to be skewed by these gig economy jobs. And so we're actually going to be in a recession, but we're not going to be able to tell because unemployment is going to stay low thanks to the gig economy jobs, but their really good earnings will tell you that that is where the jobs are going. And those people who are doing those jobs have to work, they have to use their depreciating asset to make their money. The money's not very good. They're going to have to rely on credit to maintain these loans on these incredibly inflated things they just got, especially if you're a tech worker and just bought a nice big new house. You're going to have to downsize that house, but you can't because all the houses are still more expensive, and you have all these credit card debts, and you have a new car that it costs a bunch. So the first thing they're going to do is downsize their cars into used cars, making new car prices crash through the floor. And what's going to happen along with that is a flooding of supply in the market, and auto prices going down a ton, defaults on auto loans going up, and the ABS market really taking a giant hit, which would affect the bank's bottom lines a lot. Which is why I'm really paying attention to bank earnings now and their liabilities because at some point they're going to spike super hard, and I think that would cause a real panic in the market.
Yeah, I agree.
But you're talking about the unemployment will be artificially low,
The larger
but you'd think like that if it was all gig economy holding it up, that average salaries would be or average earnings would be going down, right? And it doesn't look like that's occurring right now. So I don't know, something to keep in mind.
the inventory is actively keeping inventories from bloating. That it won't be effective enough. The damage is done. Here's the problem with autos specifically is that everything's tied to like fair value rates, which are wildly volatile. And so, you know, your auto loan, the price of new cars, it's all tied to these kind of arbitrary fair valuations, which are all entirely based on the amount of inventory of that vehicle available. um and people losing their jobs and stuff will get rid of a car payment before they get rid of a mortgage. So it's more that it will lead to something worse than it's going to be like the cause of any kind of crash. But they're not going to be able to artificially diminish supply enough because
Yeah,
the
to
supply
Gav's
is already
point,
out there, right? So manufacturers can cool down on their manufacturing and float their books, but it's more at the like the dealership level. Um,
yeah, that's where I think the risk is. And to Gav,
definitely calls on parts stores and parts suppliers
so
again.
Gav made a good point that the ABS market. He says it's been bolstering itself against a recession for 2 years. Larger ABS risk is in esoterics and consumer credit currently, and I agree with that. But the problem is when the risk becomes too great. I think that how the ABS market, and it has been doing that through raising its lending standards, but I think that the risk in consumer credit, kind of piggybacks into the auto sort of subprime space because, just because it's bolstered doesn't mean it's not happening.
Yeah,
Um,
don't forget that used car prices are inflated right now. That won't remain true. And dealerships are buying used cars at inflated prices on credit
yeah, and
because of the fair value system that cars are valued off of. People, so that means dealerships are buying cars far more than their future value, which is why they're charging such extreme markups for them, right?
yeah, and that's kind of what I'm, sort of. It's a full circle thing. Like, consumer credit is going to tank, and then shortly thereafter, or at least maybe at the same time, there's going to be a flood of supply of newish cars in the market. And I mean, I keep an eye on my streets, where people sell their cars, and I see how new the cars are that people are selling. I mean, I'm seeing newer and newer cars being sold, with for sale signs on them in the parking lots. Not a lot, not like there's not.
Craigslist is great for seeing what people are trying to sell their underwater cars for. You just look at
Yeah,
any large metropolitan region and see type in like lease takeover or loan takeover, and then just monitor the amount of like current inventory over 30 days.
yeah, that's a great indicator. I think we're still a little too early in the cycle to sort of see a massive influx, like, but and that probably will happen sort of, you know, during uh during a crash or during increased uncertainty in the market at the very least, right? So, I mean, we're getting there, but we're not quite there yet. I think there's still a lot of confidence by the consumer in their jobs that they do have. Like employed consumers are still feeling pretty confident in themselves, and that's why we're seeing, or we saw, consumer debt going up so much, right? And so much spending in the holidays, especially in the services side. It's because there is a large cohort of consumers who still feel okay enough to do stuff and get those things, buy those things, get that debt, all that stuff. So we're not quite there yet, but once margins contract enough to where more and more people have to resort to Uber and Lyft, uh, we are going to see delinquencies on auto loans go up, and also we're going to see
I love
newer
how
cars.
that's the
And
entire United States backup job.
dude, I mean, I saw it coming. Like it was. I mean, it's so straightforward of an answer when you're low on money, and I mean, there's always unemployment as well, but. And that's the thing is for a low paying job, is unemployment really worth it if you can work three different gig jobs and make more than your unemployment would be? I mean, your
No.
car is going to get beaten to
And
shit, but
unless you can
like,
find something more valuable to do with your time. Esoterics and CLO issuance over the last 3 years has 20-30% growth, which is over leveraging issuers in the space. People expect auto, but these fiscal concerns are bleeding into into corporate investment. Auto may feel it first, but esoterics will cause a larger impact. I don't disagree with that. Yeah,
yeah, that's actually really concerning.
I do agree that autos will feel it first. I think autos are probably the most currently at risk, but definitely not the largest risk.
I didn't know CLOs had grown that much, dude. That's crazy.
Something I guess we should go over GME and Upstart real quick, and then kind of close this out because I know a lot of people are wondering about OPEX this week. And for disclosure, I am long GME going into this week, but I am long on fairly defensive options positions. I have $20 and $25 synthetic longs
Yeah, I
for
mean,
2024 expiration, and then uh I have $25 calls for 2024, and I have $40 calls for 2024. And that is it. I am not getting any short dated exposure without confirmation of volume, and I will explain why. Since the initial spike at the beginning of January, they have run down the liquidity on XRT super, super fucking hard while simultaneously covering on IJH. I think they will use this IJH liquidity to drop the price similar to the period before the split and our August run up. GME is illiquid, but it's obviously not as illiquid as it can get. There's still a lot of range in these upper bounds. It can get much more illiquid. And since XRT is slammed, I expect them to reg show it and double down on their forwards. So
Yeah,
when they reg show XRT, this allows them to no longer meet the standard FINRA audit done on behalf of the indexes that they track. And then they move to the SEC audit, which does not count for their forward contracts or that they use to balance NAV. And so what that does is it unlocks an extra layer of liquidity during the reg show period where they can write even more forward contracts to the following quarter. So once they're on that SEC audit, they start getting more liquidity even in the absence of actual liquidity. And since IGH is kind of liquid right now, I expect that this will be used to offset any momentum created by any kind of other covering that could occur. So I do not have high expectations for Feb OPEX. I think they will likely drag this out till March, and GME is still likely to see prices in the lower bounds, especially if XRT goes back on reg show again. If we see XRT on reg show this week, Tuesday, Wednesday, or Thursday, by close, this is done. Any shorter dated positioning I would not enter without significant confirmation of a break at $25. Like, we want not
yeah,
only volume, we want pre-market volume. We want to see liquidity reversing drastically on GME, and we want a break of 25. And then if that happens, then there's a possibility that they're covering. But otherwise, I would say I don't think they're going to.
yeah. This kind of comes down to the whole, liquidity and illiquidity. Like a stock doesn't get illiquid because it's about to get liquid for the good reasons, right? And we have to sort of consider, the whole idea that GME and these ETFs, is sort of a proxy for the larger market, and
Well, it's
throughout
that they're
everything.
currently in line with the larger market, right? In a
Exactly.
bear market, they are synchronous.
Yeah, and so, this, it could, like I said, they could be drumming up liquidity for the good reasons. They could be drumming up liquidity for the bad reasons, and you have to be really cautious, especially when the market is topping out as hard as it is. A downturn in the market, could just completely reverse everything, it's not even just that; it's that the downturn in the market was also prepared for in everywhere. So it's not necessarily that they're going to try to like take advantage and take down GME. It's more that everyone's going to sell all their fucking assets and reprice shit, and GME is just a part of that.
Just
So.
highlighting some previous XRT reg show inclusion periods. See how they use up all the liquidity on XRT before dropping it on reg show, and then they get another surge of liquidity without any actual covering in the underlyings. Um, this has been pretty commonplace for them for the last year, and we think we've mostly narrowed down the reason they use reg show on XRT specifically for this, because ETFs, even though there is no market for single stock futures anymore, ETFs are still allowed to write them to themselves and act as their own counterparty in the transaction. However, they're only allowed to write them out 1 quarter, which means that those transactions would come due. Now, if there's a deferral or if there's a reg show inclusion, they can then roll them out another quarter. And that's where we get, some of these delays. I don't think F-Man's dead on GME, but there is a deferral this week that should be noted. There's a holiday deferral from holiday extension deferral from FINRA.
Yeah, I'm just really cautious this OPEX because of the broader market trend. I mean, if the market's going to trend down, so is GME OPEX notwithstanding. I mean, it's not 2021 anymore. So we can't treat GME like it's, inches away from popping every 5 days because it just seems like it's no longer the case.
Yeah.
So yeah,
Um,
I'm gonna be super cautious. I'm not getting anything on GME unless there is, yeah, like you said, a break of 25. I'll probably buy a 30 call.
yeah.
That's about it.
Yeah. I'll get leverage if I need it, but you can always, if it's a real OPEX, you can always scalp it. There's plenty of time.
Yeah,
Is November
exactly.
OPEX finally hitting? So it kind of did. Over the deferral period we had covering on every 4210 deferral date, we saw liquidity flow back into some ETFs with the exception of XRT. XRT only became more illiquid through the period as, XRT liquidity was used to suppress price and prevent a flip in the market maker hedge, as were a significant amount of short calls. But I think the liquidity realization we were going to see, that's it. It was, that period from, Jan 6th on the 4210 date through the uh January 24th 4210 date, and then we saw a little, we're very illiquid right now until XRT is reg showed, or until they tap IJH for liquidity, which they have avoided doing for several days now. So just because they're not using the liquidity doesn't mean they don't have it.
Yeah.
As far as Upstart goes, Upstart has, achieved a significant amount of liquidity through two covering events, one before earnings, one after. The deferral period obviously saw us break Gamma Max. By, it was about 14 something percent, right? And then even more liquidity realized in this post earnings period. Upstart currently pretty liquid. I would expect a full period of shorting on it before we see any significant price improvement again. So this is the time to sell CCs. This is the time to get prepared with CSPs. Once liquidity drives down a little bit and it starts to stagnate, probably some really good opportunities in there for short strangles. In order to keep capitalizing on it, IV on it remains higher than GME throughout this entire period because it's harder to crush. The lower float and lower relative ETF liquidity make it not only more difficult to short, but it will become illiquid much faster than GameStop will. And so, by the time GameStop reaches a peak period of illiquidity towards like March OPEX, Upstart could also reach the same peak, even though it is currently more liquid on paper than GME is.
Yeah, this kind of comes full circle to the idea of market synchrony, right? If we are going to have an OPEX event, right, then um, you know, this idea that Upstart is so liquid, sort of makes you want to be more cautious too. Once again, liquidity going up could be for the good reasons or the bad reasons. So just always keep that in mind.
Mm.
Yeah, I don't know what else to really add. I think everybody knows how I feel about GME right now. I will say, I mean, a lot of people get upset when we talk about like, oh, before we were bullish on 38.59, it's not a meme, and I think it's important to recognize that situations change over time. I mean,
I
when we
just
were
want to
talking,
put this out there. That's the first time you said 38.59. I literally turned it into a meme.
I know you did. That's what, yeah, it was hilarious. But I mean, at the time when we were talking about that, we hadn't gotten into this region of delayed or deferred obligations in an obvious way, and we were looking at an options chain that could have supported at the time a run to about 38.59. I mean, part
Yeah.
of that was based on where Gamma Max was at the time, and historically we run about 10% right over that if there is a run, right? Um, if we had a run, we probably would have gone somewhere in that range. And I think, when that October 31st blip happened, we got up to pretty close to Gamma Max. There are other reasons why we didn't go above it, above $35. But at the time, that number was certainly plausible. But then, now at the present time, a lot of the things that led us to believe that 38.59 was plausible back then are no longer plausible. And I've been trying to make it very clear that my thesis on this stock has changed dramatically since that point. I mean, you're looking at a stock that now has a gamma max of $24.50, and it's dropping every day. So even if you're expecting 10% on that, what's that, like $27? Obviously that can rise during a run, so maybe you're looking at 30. I don't know. The other thing to look at is we can pull out from the options chain. This is something I've been playing with more recently, looking at where, or the probabilities that the market maker is pricing in for a stock to move in the future, right? So they look and see, okay, based on where people are buying and other conditions that we're aware of, we're going to price it this way, and we have a most probable number here and a most probable number there at different dates. And right now, the market maker is pricing in a future maximum price of $22.88. Before January, this number was up in the 32 to 35 range, right? Also consistent with that 38.59 thesis back at the time.
Yeah.
Now they are pricing in no upside, none. And they haven't been pricing in any since Jan OPEX. The downside they are pricing in currently sits at about $15.67. That is, again, they're pricing it based on an expectation of where they think it's most likely to go. So we have no upside range, according to the market maker, and a fairly significant amount of downside range. We've also talked, everybody here talked about all of the liquidity that the shorts are positioning to use to manage, any pinch points. I really just don't see a whole lot of upside potential here, right? I mean, retail is largely losing interest. There's not really any potential catalysts that could be foreseen other than earnings, and the market continues to sort of push retail away from riskier bets as they're leaving the options markets and moving to other things. So let's see. The prime borrow on GME has been going down over this period.
Shares have been returned.
Shares have been returned.
I don't
So
think that's for long. And here's I still disagree with you on the catalyst thing, but I just want to note why while we're talking about it. GME IV went from like 132 overnight to 88. It got shorted. It got shorted hard after that last little spike. I think the short vol positions are already in, and they're in for at least the next month, right? So that is still a catalyzing factor for price action. I don't know how much it'll be by the time we get to that point, obviously, but those positions are there, right? And they're not leaving. They're not going to go anywhere. And neither really is a large portion of retail. I think we've been looking for retail sell-offs for a long time, and I still don't think the sell-offs have breached, like the capitulation on long positions has breached the accumulation of them.
maybe I
No,
think it's
it's worse. Yeah, that I'll agree with.
yeah. I mean, another, if I look at the data as well that we pull for GameStop, I mean, historically, the bullishness of the current options chain based on, the Ivy Smile and other things is already sort of at an elevated level like you would see, during or shortly after a run. And so we're kind of at the point now where we're saying if we want to see significant upside from here, we would have to see levels of bullishness that we have not seen in over a year. And I don't know that I really want to put money on that.
That's fair.
Um,
I don't think now is a great time with the trend in their margins and earnings leaning the way it is to get out, because I do think Jamie would be repriced on continuous positive FCF and positive EPS. I think their short-term focus on profitability will ultimately be successful, even if they were not able to generate actual profits simply because of the closure of their like liabilities with stores that don't produce any profit and simply only cost overhead, which is a lot of stores. Uh, but
yeah, I'm in a town with like 200,000 people and we have at least two GameStops, so we do not need
yeah,
that.
so I mean, I don't think now is a great time to exit. I still think GME is a okay, slightly defensive investment for a recessionary period. And possibly they could even see more interest as they explore other products besides just used games. But even on the used games front, they may see more business moving forward as people are incentivized to save a little bit of money on cheaper entertainment, which is something that people historically seek out during periods of recession. And I think video games in general will see growth if we move into a recessionary period, because it's time for entertainment value. Uh, it's a good ratio.
Yeah, I mean, I think holding it or, buying it sub 19, 19 sub 19 to 17 is a great price. I don't, I think we are obviously running a risk that they don't turn around, right? And we'll have
Yeah,
much more clarity on that pretty soon. But yeah, I mean, I agree. It's not a very flashy business, but it's making the sausage to some degree successfully. But that's not really what we're talking about here. We're talking about, is this thing going to go to $40 in 4 days?
no.
And the answer is probably not. Don't place those bets.
Even if we
But if
ran
you want to,
above Gamma Max right now, we would probably cap out around like 26, 27 on a real OPEX run, because there's just not enough positioning there already. And then, sure, we'll get FOMO, but it probably won't raise Gamma Max that much. FOMO's not what it once used to be. Even in March, we started running, and the FOMO piled in like crazy and drove that Gamma
yeah,
Max up. But like, you know, in the next run in May, FOMO came in, but it didn't come in as hard. FOMO came in through June to August, beginning of August, but there was nothing to drive the price action into all the FOMO. So, we kind of drifted up as
yeah,
short
it was
volatility
it was
players
scattered
left.
and disjointed. Yeah,
Yeah. And then, we haven't really since then, we haven't had a really good amount of momentum to get any FOMO to come in. So, and obviously that's reflected in our Greek neutral values. As for Upstart, no, I'm not synthetic long. I've closed all my synthetic long positions. I've sold covered calls on it. If it runs this week, I'll sell fucking more covered calls on it. I'm targeting a buyback price of, or a buy in my next buy-in price between 12 and 15, and I expect if it remains moderately liquid till March, then it could go even lower, maybe into the $11 or $12 range. I don't think that the long shorts have covered. I think it's very easy for it to end up back on reg show again. It fails at a very high uh, high ratio to the volume it trades. So I think all the potential is still there in it, and I think volatility shorts are very interested in it because it generates tons of volatility on very small amounts of volume, which is what they love. And it's not going out of business, so they get to do it forever, right? You know, stocks like Upstart and GME are very, very profitable for them because if you look at the effects of short vol on the long term on a company that isn't worth anything, and is failing, you know, it drives the price down over time significantly. But you know, if the company has a potential, or you know, has interested long investors that are not capitulating on increased prices, then you know it will either stay flat over time relatively, or you know, and then if interest peaks, then it would go up over time as they short volatility, right? And so you know it reduces the drag of short volatility on the stock by having future potential as a company, which means that volatility
Yeah,
cycles not only are more likely, they're more incentivized.
I will agree. I think Upstart right now, from a volatility perspective, looks more enticing. So if you're looking for swings, I think Upstart offers more opportunity for that. You know, their prime borrow rate is staying steady, if not ever so slightly continuing to go up, as opposed to GME's, which has sort of gone down and sort of stagnated. The options chain, it's got room, you know, some room to the downside, but it's also got a fair amount of room to the upside as well. I do also have covered calls on it and do think it's going to continue to go down for a while. But like you said, I don't think any of the serious institutional investors in Upstart are worried about it going out of business. I mean,
Yeah,
I
not at
think
all.
they're in a pretty good place, and you just listen to the kinds of questions. You know, I was listening to some of their last earnings, just because I like they actually are have enjoyable earnings calls. But they had like an hour of questions. It was like an extremely long question period.
It was
And
insane. They
you
got
listen to the yeah. It was almost like the people from all of these large banks were asking them questions not necessarily to probe the strength of their business, but to just get a better understanding of the market they were in, because they sort of, you could tell in their tone and the language they use that they respected these people and respected their opinions and wanted information from them that they felt was valuable. And so I didn't get a sense from anyone, any of the investors on that call, that they were upset or worried or concerned. It just sounded like everybody sort of was on the same page. They understand this is a short-term issue. They seem to be able to manage it. They have a good plan in place. They're implementing it well so far, and they seem fine, right? And so, yeah, this is a much. I guess to me, this is a more
I was
enticing
super
play.
impressed with their ability to grow underwritings at a flat, illiquid credit market. They're, I mean, they're kind of, they're in a shit situation macroeconomically. There's no denying it. But their ability to persevere, create growth, and improve upon analyst expectations in just a month. I mean,
Yeah.
I think the forward guidance in this earnings was even stronger than the last.
And you think about the kind of information that they're gaining for their AI platform that's so valuable here, right? I mean,
Yeah,
you usually get a lot, you know, especially in the last few decades, you get a lot more data on the times when money's easy than you do when the money's hard. So if they come out of this alive, and it looks like they will, they're going to have a really strong AI suite to handle a wide variety of credit conditions, and that confidence is going to allow them to, you know, create value where most other people wouldn't want to take the risk. And I think
I
that's
think
that's really
what's gonna be really impressive is if they're able to prove in a high default environment that on lower credit scores, their model produces more reliable debtors. I think
Yeah, I
that's
like that.
huge moving into a stable credit market because people are going to start to drop, their Experian and TransUnion contracts, and risk desks are going to start to move to Upstart, being able to approve loans at credit scores, 100 points lower with a lower default rate is huge in that industry. And then when they move into that environment, they've massively increased exposure to auto business and home loans as opposed to where they were before, and they're picking up new clients. Like their new client growth even in this market is insane, and they're still selling loans. And if they're able to unload the loans on their that are currently on their balance sheet, so as we approach stability, banks will come and purchase those loans from them, especially given that the interest rates on them are going to be more favorable. um, their valuation immediately goes up because
yeah,
now all of a
pretty
sudden they have
baller when they're
all
just
that
like,
free cash that they've been using and that's been devaluing the company now back in their pocket. They also have a credit a revolving credit line of like 600 million at like 0.25% interest, which is basically same as in this environment. It's almost better than cash.
yeah, I thought it was pretty baller when they were like, yep, and we've maxed out our balance sheet on loans that we can give out. I'm just like, all right, well, they believe in their software, so
Yep. So yeah, if you could, and part of that is why I think Upstart will continue to see cyclical volatility price action. I think the large 40% odd short position on it is wrong, and it remains like a strong buy even in this economy, because once we get to a credit stable market, its valuation can skyrocket.
yeah, it only makes them stronger when they get more of this bad data, because then their model will become more informed. I mean, literally, it's just learning every day, and it just needs more data from bad times. And now they have the opportunity to capture that data they need to make their model even better. So this is actually a good time for them in terms of creating, this AI system.
PMCPs on longer dated puts for the SPY, a little riskier than PMCCs. Uh,
All
Lowest
right, I
Upstart can
gotta go.
possibly go in the next 6 months. There's no telling. I mean, we could see it drop as low as like 8, but I'll just buy more at those prices. But
I gotta see you guys, so
all
I'll
right, later,
see you
Doric.
guys on Tuesday. Peace out, guys.
Later,
See
man.
you, Dork.
Yeah, I'm gonna shut this down because I got a bunch of stuff I got to do today too. But hopefully that
Yep.
everyone's filled in on everything. Um, just remember, downside on indexes is generally realized faster than upside, and so PMCPs are far riskier. Generally, market declines are rapid. Fear begets more fear, and stop losses have a cascading effect on price volatility. But all right. Well, thanks, JFresh, for coming on, and Dork, if you can hear me still. Thank you guys. I always
Yeah.
appreciate it. And then thank you guys, everyone, for tuning in. If there's any questions I didn't get to, or I missed, you can DM me over on Discord. I'll try to get to you when I have some free time, probably before tomorrow. And then I'll have the Pickles picks out tomorrow night. Yeah, tomorrow night. The more
Happy President's
information, the
Day.
better. So, what's that, man?
Happy President's Day,
Oh
everyone.
yeah, happy President's Day! And for anybody that's unaware, the markets will be closed tomorrow, Monday, February 20th, in observance of President's Day. Thanks, Gaff. Like the stream. do the stuff. Hey, Gurk, you missed a Ko-Fi.
Let you handle that. Have a good
Okay.
one.
Later, Jay Fresh. I don't think I did. If we assume this OPEX may not be happening, how low do you think GME could drop before March potential OPEX? I mean, I have $17 covered calls out on GME right now that I'm not really afraid of losing. I think if they drop the price, we're likely to see a similar low to the one we saw in the end of December. So 1850 to 1550 range is possible. At least, you know, short variance is profitable until like 1650. So you know, but they can short beyond the point at which their short is profitable. So keep that in mind, you know. But I would say that, you know, there's still a lot of buy interest at that price, at least right now. If the market crashes, yeah, I mean, GME could go to like $3 or $4, but that's not happening yet. Anyway, yes, thank you guys all so much. Pickles Picks tomorrow night. Everyone have a great rest of your weekend, and try to enjoy the holiday. I know it's hard. Later, guys.